High-frequency trading. This video shows you what high-frequency trading is and why microseconds matter. On one side is the broker, who wants to buy or sell a great amount of shares. Of course, that works with a computer program. The trading screen shows the market. The market used to be the New York Stock Exchange or Nasdaq. Up until the early 2000s, no stock was traded on both. This has changed. Now there are a multitude of exchanges and every stock is traded on all of them. This is necessary for high-frequency trading to work. Let's say the trader wants to buy 30,000 shares of company XY at no more than $10 a share. The screen shows that enough shares are offered at $9.95. The trader pushes the buy button. The computer program routes the request to the different stock exchanges. But it takes time for the information to travel through cables and switches. Not a lot, but still significant. This means that there will be a stock exchange where the order arrives first. Let's say that this exchange is BATS. The order is carried out. The shares that are available at BATS are bought at the given price. Here, the information about the buy order is collected by the high-frequency trader. Because his connections are faster, he can now buy the remaining shares first. Afterwards, he offers to sell them at a slightly higher price. The difference in price is tiny. The average profit a high-frequency trader makes is 1/20th to 1/10th a cent per share. But at a trading volume of $225 billion per day on the US markets, this means that there are hundreds of millions to be made on a daily basis. For the high-frequency trader, it is enough to be a couple of milliseconds faster than the broker to grab the remaining shares. But the competition between high-frequency traders is high, so they need advantages in microseconds to stay on the cutting edge. This is the reason why high-frequency traders are now making fewer trades and less money each trade than a couple of years ago. A regulation of the Securities and Exchange Commission helps high-frequency traders to get the needed information. Brokers are required to make the deal at the best price. For our broker, who wants to buy those 30,000 shares of XY, this means the following. If 30,000 shares were offered at $9.95 on the New York Stock Exchange, without the regulation, he could send his request directly to the exchange and get those shares. But on a different exchange, there are 100 shares at a lower price, so he is required to buy those first. These 100 shares are the bait put out by the high-frequency trader. High-frequency traders place buy and sell orders for shares of every interesting stock on all possible exchanges in the minimal required amount. The broker has pushed the buy button for those 30,000 shares. The algorithm of his trading program buys the shares with the best price first. These were bought from the high-frequency trader. While the request for the remaining shares travels through the network of cables, the high-frequency trader bids on those shares himself. Being faster, he is able to take the rest of the shares off the market. Shortly after, he offers them at a higher price. To be able to be that fast, high-frequency traders place their systems directly into the buildings of stock exchanges. These get a high rent for the service. Investigations are difficult. This is shown, for example, by the flash crash from May 6, 2010. The Dow Jones Industrial Index fell about 1,000 points in a couple of minutes and recovered afterwards just as quickly. According to the New York Times, the shares of Procter & Gamble and those of Accenture were traded between 1 penny and $100,000. In 14 seconds, between 2:45 p.m. and 13 seconds and 2:45 p.m. and 27 seconds, high-frequency traders carried out over 27,000 contracts. What and who caused all this, who is to blame, and who gained a fortune is hard to tell. Whereas microseconds decide over what trade is made, the stock exchanges only keep records by the second. High-frequency trading is currently being investigated by the FBI, the Securities and Exchange Commission, the Commodity Futures Trading Commission, and New York's Attorney General. Hopefully with success.